Hello and welcome to M&A, Murders and Accusations, the good, the bad, and the ugly of selling your business. We dig into what you need to know and how not to kill the sell of your business. Now here's our host, Rick J. Krebs, Mergers and Acquisitions Advisor.
Hello, everyone, and welcome to M&A, Murders and Accusations, the good, the bad, and the ugly of selling your business. This is Rick J. Krebs, the M&A cowboy, coming to you from Heber City, Utah. It's a beautiful fall day today. Thanksgiving's coming up, and I am so excited about our guest today. First of all, I've known our guest, we were counting, it's been over 40 years, probably maybe even closer to 50, I don't know, but anyway, we go way, way back. And my guest today is the Senior Vice President from Transworld Business Advisors and a good friend. I want to introduce you to Treve Kinsey. Treve, welcome to the show.
Thanks, Rick. It's great to see you again. Don't get to see you near as much. And, you know, as Rick said, Rick and I actually went to high school together. We were best friends in high school and have kept in touch over the years. And you know, probably done a lot of things in our career paths very similar. So,
yep. And Treve is the reason that I'm in M&A or business brokering. He's the one that recommended I do this, so it's your fault.
It's my fault for sure.
So, tell us a little bit about Transworld, Treve.
Yeah, well, for the people watching, I know this segment's really geared more towards the brokers and the M&A advisors. Transworld, we are the largest business brokerage in the country. Been around for about 40 years. Really started out as a Main Street brokerage. You know, we were selling pizza parlors and hair salons and all of the smaller deals. And you know, 15 years or so ago, that really changed. We kind of swam upstream and started jumping into the M&A business. About 10 years ago, we actually opened a separate division for mergers and acquisitions. And so now we have the two divisions, the Main Street division and the mergers and acquisitions division. We have around 250 offices around the country now. And my role here at the company is I run the state of Florida, which is about 100 agents. We close about 450 transactions a year. And I do support for the nation for all the other offices around the country because, you know, when someone has a problem, I tend to be the person to help them through those problems.
So you're the fireman. You put out these big fires when the deals are going.
Yeah, that's kind of my nickname at the company is the fireman. Is you know, people around the country call me when they've got some major issue that comes up. And you know, that's why I'm a little bit passionate about this particular topic, because it seems to be this topic more often than not. You know, the working capital things come up. And so you know, I prepared a presentation a couple of years ago about this, and you know, it seems like I talk about working capital more than I should.
Yes. So before we go on, we've learned about Transworld. Tell us a little bit about yourself and how you got into business brokering / M&A.
Well, you know, I owned a company. I lived in Colorado. I live in Florida now, but I lived in Colorado and I owned a fairly good sized company, and it decided it was time to move on. So I had sold it. And I was in multiple states at the time. And so I had a nationwide no compete. And so when I decided I wanted to go back to work, because I do love to play golf, as you know, yes. I played golf every day for about 6 months and went, man, I'm bored out of my mind. And so I decided to go back to work and had a nationwide no compete. So I had used a business broker to sell my business. And I kind of went, man, that guy had a pretty good job. And I felt like I was as good or smarter than that guy was. And I just paid him a bunch of money to sell my company. And I went, you know, that seems like a pretty good gig. So I actually interviewed every single business brokerage company that I could find. And I ended up at Transworld, you know, quite honestly, because at the time, Transworld was really the only company that had a lot of support, you know, to teach us the business, because, you know, in this business, you need support. You need somebody to teach you and help you along the way. So.
Gotcha. And something cool about yourself. I always do this. Something cool about yourself that most people wouldn't know.
Well, I think most people who know me know I'm an avid golfer.
Mhm.
Um, but one of my problems with my golf game is I hate to practice. I love to play and I hate to practice. So I never get better. So I am the same handicap today as I was when I was 15 because I don't like to practice.
I think that was the same with basketball and football back in the high school days for both of us. Neither of us like to practice.
Uh, yeah, for sure. For sure.
All right. So this podcast or this webinar today is about working capital, and it's for business brokers and M&A professional people that are in the business like us. We wanted to get the word out. People may think, oh, you're crazy to try and educate others, but you know what? As the level of the sea rises, all boats also rise. And that's what we feel like is we want to get this word out. We want to tell people about it, people that are in the business doing what we're doing, quite frankly, so you don't get clobbered and so your deals don't die on you in the last little bit. So what typically happens, and as you're going through a transaction, you go through due diligence, and that's 30, 60, sometimes 90 days. You're dealing with banks, you're dealing with attorneys and accountants, and the buyers and the sellers get something called, and Treve has brought this up before, it's called deal fatigue. They're just worn out, aren't they, Treve? They're just
Yeah, deal fatigue's a real thing. I actually talk about it, especially on these larger transactions that take a long time. It's one of the things I talk about right from the beginning with buyers and sellers that you're going to get tired and you're going to get grumpy and you just got to remember that that's normal, and just try to prepare them for what's going to be going through them emotionally because it's an emotional roller coaster, especially for the seller selling, their business. It's their life's work, so.
it is. And what happens if working capital is not dealt with earlier on, I want to say at the LOI stage, or at least through due diligence, first part of due diligence, is buyers and sellers are surprised by it. It will come up, right? And when it comes up, it can swing the cash in the pocket for the sellers several $100,000. They get surprised by it and mad about it, and they don't understand it.
Right. So, I mean, one of the things that I try to do and I try to teach all my agents to do is talk about working capital from day one. And when I mean day one, I don't mean day one of the purchase agreement, the asset purchase agreement, or the LOI. I want my agents to be talking, especially to their sellers, about working capital, right there at the listing appointment.
Mm-hmm.
When you realize there's going to be a working capital component, we're going to talk about what makes a working capital component here pretty soon. You really need to address it right there at the listing appointment. Because the last thing, as Rick just said, is you don't want your sellers and your buyers to be surprised. You don't want them thinking they're getting an extra $1 million when they've got to leave that working capital behind. So I like to address it right up front from day one.
Yeah, that is so smart, Treve, because part of our job is to educate them about what's normal, but to have these hard conversations. Sometimes I know the guys will run from the conversation in order to get the listing. They're like, well, I'll kind of hide this and not tell them about it, and we'll just get the listing. And boy, that's just not what you want to do. You have to have, they're hiring you to have these hard conversations and tell you the things that you need to know going into it. I think that is so smart.
The last thing you want to do is spend 9 months working your tail off and get right to the end and you hadn't been honest with your seller and all of a sudden you lose your deal. You don't sell the business, you don't get paid, and then all of a sudden we get the dreaded bad Google review, because nothing's worse than that bad Google review.
I know, and everyone's mad and they're all looking at you. It's just not,
Right.
it just sucks. And you worked for 9 months, right? Thought you had a pay.
Yeah.
It really sucks.
The thing they always say to, especially the sellers, is this is why I hired you. So we would know these things. So these things would be taken care of. That is why they hired you. Because if the sellers knew these things, then they wouldn't need us.
Yep. So we could give many examples of this. I want to tell one recent example that I had, and that is that working capital includes cash in the business. And a lot of sellers are sitting on a lot of cash right now because of the PPP money or the retention credit, or, sellers just like to stockpile cash in their business as an insurance policy if they need it. And I had a transaction where they had an extra $1 million in the business, and the buyers saw it. It was in the business, and then they removed it after the buyer saw it. So the second time, they look at 1 month worth of financials and there's $1 million in, they look at the next month and it was gone. And the buyers felt jilted. They were so mad about it. They're like, oh, you stole our money. So anyway, and I told the guys not to do it. And I told them about working capital. But my point is, sometimes the sellers think that money is theirs, which it's not all of. And sometimes the buyers think that money is theirs, and hence that's where we get into entanglements. That's where we get into issues.
Well, Rick, why don't you start with, why don't you give us the definition of working capital?
Okay, I think that's a great idea. So working capital, the accounting definition of working capital is current assets minus current liabilities. And current assets are cash, receivables, inventory, prepaids. We're going to go through a whole list of things that you may not see, but that's generally what we see. And then there's accounts payable. It usually does not include long-term debt. It includes accrued liabilities and accounts payable and any short-term liabilities. So that's the accounting definition. But what do we see in transactions, Treve? Do we see the accounting definition used or some other definition?
We do see the accounting definition used sometimes. And it's interesting, you were bringing up excess cash right there.
Mm-hmm.
What we're trying to get to when we do a working capital calculation isn't always necessarily what's in the business today. It's really what you're looking for is, what does the buyer need to run the business and for a period of time until the cash flow is normalized. And it's really a function of receivables as much as anything. If you have a lot of receivables and an extended period of receivable time, if the seller takes all of the assets, the cash, the receivables, and things like that, it might be 90 or 120 days before the buyer starts getting revenues in the door. And all that 90, 120 days, they've got expenses. And that's really what the point of working capital is. It's to get them through from the time of purchase until the normalized revenues are coming in. And so that's the big thing I think people don't understand, is that, the buyer, if working capital is not included in the deal, then that buyer has to fund that working capital out of their pocket. And, a lot of times they just don't have the money to do that.
Gotcha. So we're talking about two different types of transactions. One is a Main Street deal, and one is, we call it M&A deal, right? A larger deal. So
Right.
why do guys get blindsided? If they're used to doing Main Street deals, why do they get blindsided by this working capital thing?
Yeah, well, in Main Street deals, there really aren't a lot of receivables, to be honest. If you sell a pizza place, for example, you make a pizza, they pay it right there at the counter. You don't have receivables. And so that's really what happens is, the Main Street people, especially, they just don't deal with working capital because they typically don't deal with a lot of businesses that have receivables. And to be honest, most businesses don't have receivables. It's typically only larger businesses that have receivables. And, I think that when people ask me, what's kind of a good number to really start worrying about working capital, my kind of answer to that is, if they have over $100,000 in receivables, that's when you really got to start paying attention to the working capital problems, because that really becomes a cash flow issue for the buyer if that working capital isn't left behind.
So it's not necessarily the size of the business, are receivables part of the transaction?
Right. Because, look, if you've got receivables and you're not collecting those receivables for 30, 60, 90 days, and you come and buy a business, and let's just say it's 90 days, you come and buy a business, you're not actually going to have any cash flow, any revenue for 90 days till those receivables start coming in. And you got to be able to run the business and pay your expenses, your employees and your inventory and your rent and gas and all the other things that you have expenses for for those 90 days. And so that really is the function of working capital, whether you get it from the seller or, in the smaller SBA deals, the SBA lender will actually give you a working capital loan to cover those expenses until those receivables become normalized.
Gotcha. Yeah, I've always thought that it was deal size, but I get your point about receivables. That makes a lot of sense. So early on, I was selling to smaller businesses. That's what I did, and you get blindsided. I see these brokers, they just haven't dealt with it. It's just not seeing it every day. And then all of a sudden to get a little larger deal or one that has receivables, and then they're getting blindsided by this working capital thing. Yeah, I see how that could happen. And unfortunately, it happened to me early on as well. You learn that lesson the hard way.
Right. I think it's happened to everybody early on. It happened to me as well. When you first start out, you start working in smaller transactions, and then you kind of swim upstream, and all of a sudden you get a large transaction that's got a component of working capital, and you'll get an LOI and it says working capital included, and you scratch your head and go, I wonder what they mean by that. What does that mean? So the important thing is don't ignore that. Really, make sure you understand what that means, and ask the buyer exactly what is your definition of working capital, because buyers definitely have different definitions of working capital, and so I like to get the calculation right from the buyer. When you calculate working capital, how are you going to calculate that?
And as we know in the business, the intent of the letter of intent or the offer is to align the expectations of the buyers and the sellers. The better you can align it, the more clarity you can have. I mean, you can't ever be too clear in an LOI, and the better off you're going to be. Yeah, totally get that.
Yeah, no question. And one of the things that I think most brokers make a mistake on is they don't deal with the alignment of the working capital soon enough. They wait till a week before closing and try to deal with it. What I try to teach is to get the buyer and the seller in agreement on the standards of working capital and how it's going to be calculated during the due diligence period.
Gotcha.
I want to make sure that before we get done with due diligence that they both agree, hey, this is how it's going to work. And, and it might be a little bit of a range. It might be, between $1 million and $1.2 million worth of working capital, but this is how we're going to come up with that number. And that way there aren't any surprises, because you don't want the seller thinking, hey, he's only going to have to leave $100,000 behind. And all of a sudden the buyer a week before closing says 1.2 million.
Whew.
That'll kill a deal quickly.
Yeah. And I like what you said earlier, like when you're getting the listings, tell the sellers, okay, you're going to have to leave some working capital. Let's put a range here. It'll be between, say, 200 and 400,000. So they know right up front. And then, then once the formula is calculated during due diligence, it comes in on the high range at 400. Sometimes it comes in at the low range, but at least they know. And then your transactions aren't blowing up. Love that. Absolutely love it.
Yeah, and it becomes a function of price when you take in the listing as well, Rick. One of the mistakes I see all the time is brokers will go into deal stats and the business reference guide, and they'll see multiples on these businesses, and they'll find comparable sales, and as we all know, when businesses make more money, they sell for higher multiples. But one of the functions of that higher multiple is that the sellers are leaving working capital behind all the time.
Yeah.
And one of the mistakes that the agents seem to make a lot is they want to take that multiple and then add the working capital on top of the price. And that's not how it works. The multiple always includes working capital.
Gotcha. I mean, we'd love to add it to the price. I think early on I did the same thing, more commission.
Yeah. We're commission based. We sell it for more, we make more money. But the reality is you're setting unreal expectations for your seller.
Exactly. And the buyers will slap you around anyway and bring it down.
Oh yeah, absolutely. Absolutely.
So we've talked about the need for working capital and how it works. Let's take a minute now and talk about how it's calculated. You mentioned before that SBA has their own calculation. Tell us about that, Treve.
Right. So I actually had gotten my when I did my presentation at the Transworld conference a couple years ago, I went to one of the SBA lenders and I asked them for their calculation, how they do it. So what they do is they take the revenues for the year, they subtract the income, and then they subtract any depreciation or amortization. So an example would be if they had $5 million in revenues, they made $1 million. I like to use easy numbers, Rick.
Yeah.
And they had depreciation of $50,000. That would mean their cash expenditures for expenses is 3.95 million. So what SBA does is they'll divide that 3.95 million by 365 days. And then they will take the receivable cycle and see how long the receivable cycle is. And you say it's a 60-day receivable cycle. They'll take that daily rate times the receivable cycle, and they'll come up with the working capital needs. So, in the example I just gave you, the 3.95, you could divide by that by 365, comes to about $10,800 worth of expenses every day. And if you had a 60-day receivable cycle, the working capital would be $650,000. So that's the way SBA does it. And to be honest, I like the way that SBA does it, because that's really what you're talking about in working capital is you want to make sure the buyer has enough money to pay the bills until the revenues start coming in. And that's really what this is about.
Gotcha. So that's more of a income statement or P&L calculation of working capital, where traditional working capital is based on the balance sheet, right? Based on
absolutely.
Yeah, I like that also. It's more of a working capital calculation. I want to say.
And that's always the argument, going back to the excess cash that you're talking about earlier, is so many businesses leave excess cash in. Mm-hmm. And so when you're looking at the balance sheets, the working capital that might be on the balance sheet isn't always the working capital that's necessary to run the business.
Yep. And get it out. Tell your sellers, get that excess cash out. Let's remove that so the buyers don't see it. But I love that.
Right.
So we've talked about how it impacts the selling price. And what you'll do is you'll calculate a target amount, and then you'll calculate it at the after closing. You'll have a closing date based on an estimated target amount. And then after closing, it can impact your selling price dollar for dollar, either increase it or decrease it based on the final amount of working capital. So that's another reason it's so important, because it goes right to the bottom line. It impacts your selling price for the good or for the negative, depending on how much is there. So sellers anticipating taking a bunch of cash out after closing or right at closing, it stops that.
Right. The other way I've seen them do it, Rick, is if it's a little bit higher, the seller's leaving too much working capital behind, I've seen them just remove it.
Yep.
Prior to, they'll just remove it. And a lot of these deals are asset sales as opposed to stock sales anyhow. Mm-hmm. So the buyer is really just transferring, the monies over to the seller, so you can't just transfer those amounts, higher or lower. But if it's going to be lower, obviously the seller's going to want to pay less money.
Yep. The buyers will want to pay less money for it. I see where they transfer the money.
Sorry.
That's the cleanest. I knew what you meant.
Yep.
That's the cleanest, just to take it out. Or I see where they'll adjust it through the note. But it does impact selling price, and it does impact the cash in the seller's pocket, and cash out of the buyer's pocket. So let's talk about some specific things in the calculation of working capital that I don't normally see. These are ways which sellers get tripped up. One is accrued liabilities. A lot of these companies are on cash basis. They use cash basis accounting or modified accrual basis, and they don't do a full accrual financials each month. And so I'll see where they don't accrue their liabilities, but it counts as a negative against them. Vacation. I see a lot of companies where they will just, pay their people as a vacation is taken, but they don't actually accrue it in the books. So that's one of the things that we see. What else do you see in the working capital calculation?
Yeah, you'd mentioned it earlier. You see the prepaids quite a bit.
Yeah.
The prepaid expenses, the prepaid insurances, prepaid deposits. You might have prepaids on inventory, things like that. That you have to take into consideration as well.
Yep, and deposits are a big one. Like we sell construction companies. You were told me earlier about a window company that had deposits. Tell us about that one, how that works.
Right. So that's more of a working cap or work in progress situation than a working capital. But the gist of it was a business did about 6 million in revenues, made just over $1 million. And when COVID happened, as a window replacement company, the supply chain really got backed up. So instead of getting the windows in a couple of weeks when they would order them, they were 6 to 7 months out, and they would collect 50% deposits from the customers when they would buy them. So when we got into the business, they were sitting on about $1.5 million in deposits. They had 267 outstanding jobs at closing and about $1.5 million in deposits. So the first thing I said at listing is, you guys understand that $1.5 million isn't your money, right? It's your customer's money, and it's going to be the buyer's money to complete these jobs. And one of the tricky things with the accounting portion of it, because they were on a cash basis, they had paid taxes on that money already. And so it really became an accounting issue when they had to leave it behind. So they had to refile taxes and things. But we ended up closing the transactions, about $3.5 million transaction, and they literally left $1.6 million in cash behind. So it was a big number, but none of that was actually working capital. It was all work in progress money.
Wow. Oh man. Well, that was really good that you told them, hey, this money isn't your money. This is your buyer.
Yeah. Fortunately, I addressed it right up front. I addressed it right at the listing appointment, was when they went over how much they were sitting on these deposits. And working capital is a different discussion, I guess, but it kind of works the same, because it really is, working capital, work in progress. You're still, at the end of the day, you got to leave money behind to complete those jobs.
That's right. And if the brokers out there don't understand working capital, where do they go through the process? I mean, you got your sellers, where do you go?
So, look, there's several education groups out there. The IBBA, for most people, is a great resource for education. That's the whole reason it was, came to pass. I will tell you, at the IBBA, the best class I ever took in all of them has been the working capital class, 10 or so years ago, because, to be honest, I didn't really understand it. Mike Idakari teaches a class every year at the IBBA. They always, 1 or 2 classes in working capital, because it's such an important portion of what we do. You can also join the M&A source and some of the other groups. Kennesaw State University has an M&A program that talks about working capital and teaches you how to calculate working capital.
Gotcha.
I will tell you, education. You have to invest in yourself and your education to be great at this business. And if you don't do those things, then you really are going to fall behind. You're going to miss large paychecks because you make mistakes.
Yeah. Oh yeah. And we all hate to see that. So one other thing I think is important is, if you're in the middle of a transaction, to get the CPA involved, get the seller CPA involved, because they can be very helpful in these calculations.
Well, I will tell you, if you've got working capital and work in progress, it's a must to get the CPA involved early, to really start working on those things. They're really the only ones who can do it. And so you make sure you're on a friendly basis with them, because they're going to be your best friend for the entirety of the deal.
Oh yeah. And if the number is bad, then it's coming from them, their trusted CPA who they've worked with for years, and they trust those guys to make those calculations. I think sometimes we try and make them, and we will miss something, and then they look at us as a bad guy on a new relationship, and that's not where we want to be.
Right. And I think sometimes sellers, they love to think that we're just in it to make our paycheck. Yeah. And so when you give them bad news, they don't want to leave you, or they think you have an ulterior motive. And hearing it directly from the CPA, really makes a big difference in trust. And they've trusted that CPA for years, and a lot of times we're relatively new in relationships with them.
Yeah, I love that. So there's one thing I wanted to just go through a list here of things that are included in working capital that we often see. One is accrued liabilities. Other one is cost in excess of billings. We see this with engineering firms where they'll have cost in excess of billings or billings in excess of cost, which is a liability. Deferred revenue is a big one that you had in the window company. Deposits, prepaid items, insurance. Oftentimes you'll pay your insurance once a year and it's prepaid. And if you haven't included that in the working capital, you just lose out. You just leave money on the table. Insurance, deposits, rent, any prepaid items. Credit cards, accounts payable, accounts receivable, cash, as we've spoken about, inventory, right? They're going to count the inventory, and WIP. You spoke about WIP, accrued vacation. Trying to think if we
one that you hadn't talked about very much. Some of these large places have gift cards out there that they've sold.
Yeah.
But man, the gift cards, those things will bite you in the rear. You got to address those gift cards.
Yep, gift cards, love it. Is there anything else that you can think of that you experience in working capital?
Not right off the top of my head. I would tell everyone out there who's listening is, really get with, someone who really understands these things that you can reach out to when you get, things that you don't understand come up. Don't go in blind. Don't try to fake it till you make it. Because it is hundreds of thousands of dollars sometimes, and what'll happen is you'll just end up not getting paid. Reach out and ask people. Like I said before, the IBBA is a great resource. There's a lot of people in the IBBA you can just pick up the phone and call. I know people from the IBBA will call me with questions. People who aren't necessarily with Transworld will call me with questions, and everyone in our industry, or at least most people are in our industry, are more than happy to help somebody out.
And both Treve and I are members of the IBBA, and I haven't attended any of the summits yet, but Treve's been trying to get me to go for years. But I am a member of the IBBA.
Louisville this year.
Okay, I'll have to look at it.
I'm sure I said that wrong. Somebody will probably send me a nasty email. Louisville, not Louisville.
So if you're a business broker and you get an LOI and you're all excited, you're looking at price and it just mentions working capital, don't say, yeah, we'll handle that at closing. Don't just roll over that and accept that LOI. Take care of these problems early on, and you won't have problems in the end.
Right. Yeah.
Well, thank you so much, Treve, for being on the show today. We really appreciate it. And today we're talking about the ugly. What can be ugly? Don't let it be ugly.
It definitely doesn't have to be, as long as you're upfront with it. Address the problems day one, and it won't be a problem later.
Love it. Absolutely love it. Thanks again, Treve, and have a great. We're close to Thanksgiving, so have a great Thanksgiving. And this is M&A, Murders and Accusations, the good, the bad, and the ugly of selling your business. Thank you.
Thanks for having me.
Thank you for attending our podcast. We invite you to join us for future episodes of M&A, Murders and Accusations, the good, the bad, and the ugly of selling your business. You can also visit us at www.bsalesgroup.com or email Rick directly at rick@bsalesgroup.com.